for the retail individual as well. So we'll be talking about that in just a short while from now. The very first guest for today is Rahul Jain, the head of Edelweiss Wealth Management. Rahul, really appreciate you giving us your time today on ET Now. I hope you and your team at Edelweiss are staying safe amidst this pandemic. So Rahul, of course, the first question that everyone's wondering is that, okay, it's great the market has managed to rally and, or rather rebound, let's not call it rally, but it has rebounded very smartly. In the last 4 odd months, a good 40% rebound is what we've witnessed. However, Rahul, the question is, can we perhaps see some more of a rally, some more of a rebound, perhaps once again that dash towards 12,000, since the momentum seems to be so strong. And of course, every time there is news of a vaccine, you see this rally in the global markets, which trickles down into the Indian markets as well.
So I agree. I think everyone is confused on the same. But if you see right now, the market looks a little bit overheated in that sense. Primarily because of 3 reasons. One is that what you also said at the start, that stock prices or the markets have gone up by 40% in the last 3 months. So once you get such a run-up in 3 months, you are obviously looking for a cool down to happen, and that is natural to happen. That is one. I think the market depth also is fairly negative in that sense. There are only some stocks which are leading this market rally happening. And the third one is that if you look at market, it looks expensive as well. FY22 605 rupees of EPS, 18 times price to earning looks little expensive in that sense. So we feel that there can be some correction which is there, but once the correction happens and it goes down to a 10,200 level, will be a good buying opportunity. For us, I think we have been advising our clients who are trading in markets that it was a buying on dips type of market, but right now it looks heated a little bit.
Alright. We often tell our viewers, and I'm sure you as well have a similar advice for all your clients, and that's a periodic review of your investments. The other advice that we often give is that there should be a proper split, between how much you're investing in equities, how much you're putting in debt, which includes even PPF and fixed deposit, and how much you put in gold. So the periodic review will also ensure that your percentage allocation to each of these assets is sort of at those levels. With this rally or rebound that we've seen in the markets by 30-40 odd percent, in some cases it has taken along with it some shares and some mutual fund NAVs as well. Do you think now is the time to give your portfolio that relook and rebalance it, which basically is to say trim down any equities in case if it has got above the predetermined allocation in percentage?
100%. I completely agree that since if your equity exposure is more than your risk profile or your asset allocation model what is there for you, I think it's a very good time to trim them out. Also, I think it's a good time to review a portfolio, because generally what we have seen that laggards always remain in the portfolio and winning stocks always go out or mutual funds go out because people want to book profit. I think it's a good time to review those as well, because if someone is winning, it might continue winning, but laggards should move out of the portfolio.
But what about then considering booking the profit? Because when you say, Rahul, that the laggards should go out, unfortunately for many cases then it basically means that the paper loss is going to get converted into actual loss. So that fear is always there. Maybe that's the reason why the tendency to keep holding on is always there. So how do you distinguish between something that actually will show promise from here on and is probably just having a tough time right now, and something that's really never going to be able to catch up? The easiest way, of course, is past returns, but that obviously is not the only factor.
So I think you have to look a couple of things on this. One is obviously past track record, that is one which should be used. But other is that there are certain sectors which you feel will do good post the COVID or in the future in the markets, wherever you are in that situation. I think that is one way to select whether these stocks are from that sector or not. Secondly, you also come to know about the results, how the results are coming for that particular companies and how the commentaries are about that company. Also, the important point is to check on the corporate governance or the team what they have. If they are resounding good corporate governance, good team, I think these sort of companies always keep doing well. And I think these are three key criteria which you should look after: how the sector is doing, how this company is performing in their terms of balance sheet, how the company's team or the corporate governance, and these three can be a good parameters finally to give an idea where your stock is heading. And if it's not doing well and it does not come into these parameters also, then it's an easy choice to get away from those stocks.
Right, okay, fair enough. So that's just some factors that you should consider, you should ask yourself before, you sort of exit, because yeah, it's very important to bring down your exposure in equities. Use this time, like Rahul is saying, and according to him, you should use this time to sort of bring down your exposure to equities, or else it will lead to you being, in that high risk zone. Equities is an instrument that does have a higher risk attached to it. So if you do not have the kind of risk appetite, you should ensure that your exposure to equities is a bit limited, which then brings me to my next question, Rahul. This is definitely not a one-word answer. It's not just a simple XYZ answer. It depends on a lot of things. But what should be the asset allocation? And for simplicity, let's assume you have two individuals, one who is still a little younger, maybe has a long-term time horizon, planning for his retirement, one who's a little older, who may perhaps be looking to bank on this portfolio to get himself or herself some monthly income or some frequent income as well. For both of these individuals, just these two examples, what should be a good asset allocation according to you?
So I think one of the easier thumb of rule what advisor also uses 100 minus your age should be an equity allocation. So suppose the younger one is at 25 age, then he can have a 75% equity allocation and rest 25 can be of composite of debt and gold. But if someone who's nearing the retirement age, I'm sure it would be at the age of 55, 60, then in that case, I think it should be around 30-35% and it should go into fixed income where he can give cash flows and also have a lot of security in the same. So using 100 minus age is a easy one to finally come out with the asset allocation, which will be a reasonable set understanding on your asset allocation, which is according to your age effectively.
Rahul, I want to ask you actually another question, and this one's on gold. Definitely, firstly, it's something that is obviously present in every household. And secondly, this one has rallied as well. It's almost gone up a good, I think, more than 20% this year. And this I'm saying on the conservative side. I think it's definitely more than 20%. And equities, of course, have fallen, gold has gone up. So do you think that now that, we've reached this juncture and, we're talking about rebalancing your portfolio, the fact that gold has gone up and equities have gone down, does it mean that you should consider now trimming down exposure in gold as well? Maybe selling gold ETFs or e-golds or whatever form of gold you had in your investment portfolio?
So if you're trading in gold and you bought it for opportunity point of view, I think you should, because we are biased towards gold going more up. So we are biased in terms of it being more bullish. So you should carry on with the position and should play in the rally which is there, which is happening right now. But suppose again from asset allocation point of view, you were on higher asset allocation of gold at some point of time and you now want to reduce it, or you want to come to the right asset allocation, which is 5 to 10% of your portfolio should be in gold. And if you're higher, then it's good time to trim down also, because the prices are also very reasonable. But yes, we seem to be a little biased in terms of next 3 to 6 months. We find gold going up more.
All right. Well, there you have it. That's essentially, the view coming in on how you can use this rally in equity markets. Remember that the market had seen quite a drastic fall when the COVID pandemic had hit. We had seen the worst day, somewhere in mid-March where the Nifty had even gone below 8,000. But since then, it has rallied. It has recovered very smartly. And, if you guys as well have suddenly seen a sharp increase in the level of equities that you have in your overall portfolio, then maybe use this rally to trim it down a little. So you can this is your chance to even book some profits if you can, take some money off the table until it once again reaches that predetermined allocation level. A very simple way to decide what should be your allocation level is 100 minus age. So let's say if you're 35 years old, 65% of your total investable amount should be in equities. So that's of course all about investing in equities using this rally. But now time to get on board some questions and queries. We've received quite a few of them, so we will try to use our limited time with Rahul Jain to get them answered. Our very first query comes in from Joseph George. He says, I'm a new investor in the equity markets and he would like you to suggest some good names to buy for the next 2 to 3 months to build a 15 to 20 stock portfolio. He's saying that he can invest 2 to 3 lakh rupees for credible long-term growth. Now, Joseph is saying that firstly he's a new investor. He wants to directly start investing in individual equity, in shares. I don't know if he's mentioned anything about having a mutual fund portfolio. He's not even mentioned anything about, having something in a PPF kept aside or in any other debt fund. So let's assume there's absolutely nothing over there. What would be your recommendation, Rahul, to, a new investor like Joseph George? Do you think they should plunge in directly into, building up a stock portfolio of 15 to 20 stocks, especially when he's a brand new investor?
So I think since he's a brand new investor, I would not recommend him to directly plunge into stocks, because stocks and investing in stocks have their own nuances, risk, volatility, etc. And since he's new, he would not be accustomed to it. I would suggest that if he wants to really build a fortune and put it in the equities, he should go through a mutual fund route where a professional fund manager can manage his money, and once he gets accustomed to the market, he can start investing on his own as well. But right now, I think he should stick to a mutual fund route on the equity funds.
This is actually a message that we would like to convey to all those. This is something, what Rahul is saying is something that should resonate with all the individuals who are even trading, in fact. And I'm sure Rahul as well must have seen this point about how retail trading has increased quite a bit in India. You have digital platforms as well that make it really simple, really cheap as well, in fact. But you must trade with caution. Trading, in fact, can be pretty injurious to your wealth. These are some words that even some of the biggest investors of the Wall Street have, echoed. This is the sentiment they echoed. So just like how Rahul mentioned that for Joseph, it's not the best idea to straight away plunge into direct share investing. Similarly, trading as well could be even more hazardous, if not the same. Alright, let's take on board our next query. It is coming in from Darshan Vishnu. He says, I'm a salaried professional. I would like to invest my money in safe pockets for long-term returns. Currently, he just has an endowment policy and he can invest 6,000 to 8,000 rupees per month. He's not mentioned his age, but I'm assuming that he's really young. What would be your advice to him, Rahul? Again, he as well seems to be an absolute novice in investing in equity markets.
So I think if he's young at age, and so I think he can take risks because age is by side, and from asset allocation model also it says that he should be high in equity. And since he wants to put some money every month basis, so I think equity mutual fund in a SIP route would be an interesting one. And suppose he's looking for invest for 25 years, and if you look at 10% return, which is a very conservative one, I think 1,000 rupees or 1,000 rupees monthly for 25 years will convert into around 13-14 lakh rupees, which is a 5x gain. So if you want to build a fortune, I'm sure it will be a different fortune number for everyone. But equity, large part in IMF SIP route, and do it consistently so you can create a corpus for yourself in coming years.
Alright, so that's the advice coming in for Darshan Vishnu, and in fact, I think it would echo with all of the millennials, the Gen Zs who just started off their, their jobs or their businesses, whatever it may be. I think it's something that would be applicable to all of them. Okay, Vinod Katyal has written in to us saying, I redeemed 9 lakh rupees from my mutual fund holdings and kept the balance of 25 lakh rupees in good rated funds. But because of the pandemic, my investment value has come down to 18 lakh rupees. Can you suggest how can I recover the loss? Alright, well, not sure about how, if Rahul can help recover that loss. Of course, that's clearly dependent on the market. But in such a situation, and also all the more, what he's mentioning is that he needs this money for the marriage of his daughter, which is fixed for some time this year. But of course, he's sitting on a 7 lakh rupee loss, which is a bit daunting. Now, the way the situation is panning out, it doesn't look like Vinod will be able to have that big fat Indian wedding for his daughter any which ways. But nevertheless, it's quite scary, right, to look at this loss of almost 7 lakh rupees. Rahul, what would be your advice for him?
So I empathize with such investors who have lost money because of the COVID impact on the markets. I think for him, I think one thing is fortunate that market is recovered, and I'm sure that what loss he is saying right now might not remain the same amount it would have recovered. But since his goal is near exit, so for example, he needs the money for his daughter's marriage, which is very close, I think he can't time the market. If he needs that money, then he should redeem more right now. Also, if he is not comfortable in booking the losses, then we might want to reduce the budget of the marriage. That is what is one of the suggestions is there. Also, as an advice to all the viewers, customers, I think we should at least take out money 1 year before the goal gets completion of goal happens, because to a safer asset, because timing the volatility or managing the volatility is very critical in the market. So once you are nearing your goal and you're around 1 year around, it's good time to exit and move into a safer investment like IFD or a liquid fund, so that you are sure that that money will not remain volatile in terms of value.
That's actually a very valuable advice. Yes, you've done all the homework, you've set aside your financial goals, you know how much will you need after a certain number of years to achieve that goal, then you start investing, and then you have a crisis, you have a pandemic, so the value of your investment really depletes. That's the reason why it's always advisable to start removing money from the riskier asset 1 year prior to your goal, to the goal which has to be paid for, and park it in a more safer asset like maybe a liquid fund or a bank FD or a savings account, so that that corpus stays intact and it's not subject to market volatility. In Vinod's case, of course, it was his daughter's wedding. So yeah, this is something that does come in as a cautious a caution call as well from Rahul to all the viewers who may be on the angle of retiring or may have to pay for their kids' education, whatever may be the case. Remember to always remove that money from the risky asset, which in this case, of course, is equity mutual funds. Park it in something that will be less volatile. Okay, last query for today. It's coming in from Santu Mondar. He says, I'm 30 years old and I wish to retire rich. I come from a middle class background. My long-term goals are the basic: child's education, marriage, retirement. He wants to know how can he keep his retirement plan short and simple, and of course he has all of these other minor goals as well. Alright, retiring rich is something that of course is everybody's dream, right? And I think it's something that everybody should aim for. Senior citizens also should not consider their children to be their retirement plan. It's extremely important to be financially independent. So yes, Rahul, how would you advise something?
So first, it's good to hear that Santu started looking at retirement such an early age. I think that's a good thing to know. Retiring rich, I think it's a very different value for everyone. But the first step I would be that first you should know that how much retirement corpus you need. I think a good base of understanding the same is that about your standard of living right now and how much you spend every month. Effectively, then give some inflation rate to it. And effectively then you can come down that what corpus you would require for 20-25 years from 60 to 85. That's what I think. And once you're able to ascertain that corpus, I think then you should plan something which can give you a return on investment around 10%. That is conservative and will be also safe and secure. There are a lot of retirement calculators which are available online which you can use. Also you can take a help of advisor, because this is a little nuanced exercise to come with. As far as his other question is concerned about the other goals, etc., I think which is multiple goals, which is child marriage, house, what you spoke about, and other things what was there. I think for that he has to create a separate corpus altogether, and then once that corpus, the goals keep achieving, he can take out money from that and can use the same. So that is how I would suggest him to think about his retirement right now. Have a understanding that how much corpus he would require at that point in time, and the current base of standard of living or the money he spends can be a good starting point.
Okay, Okay, yeah, I think a starting point that a lot of people do tend to miss is quantifying your financial goal. It's easier to say that, okay, I want to retire at 65 and I have my child's education in 10 years and XYZ, but you have to quantify that goal as well. That's literally the first step of financial planning and the entire process of investing towards achieving that goal. All right, excellent. Rahul, really appreciate you giving us your time today on The Money Show. Thanks so much for not just, conveying that message to all our viewers that yes, this rally should be used to trim down your exposure in equities, but also, of course, patiently answering all the viewer questions and queries that we've received. Thanks so much for joining in. We will take a very short break right here on the show, but when we